This is the first quarter update for the Amplify Cash Flow Dividend Leaders ETF, symbol COWS, and the Amplify Cash Flow High Income ETF, symbol HCOW. I'm speaking with Kevin Kelly. Kevin, let's jump right in with COWS, which follows the Kelly US Cash Flow Dividend Leaders Index. What is the investment philosophy for the index?
Well, the investment philosophy is to invest in cash cows, hence the cows ticker symbol. And so, looking at that type of strategy, what it wants to focus on and seek to obtain is companies that are really looking to increase shareholder value through numerous facets, share buybacks, dividends, but really focusing on generating a lot of cash flow for their company to do M&A, reinvest in their business. So the strategy seeks to find companies that generate a lot of cash flow so they can reinvest in their businesses, they can return capital to shareholders. And one of the nice aspects that's unique to this strategy, we feel like, is it seeks to find companies that have reoccurring cash flow. So not a one-off situation in the past where they generated a lot of cash flow, because this strategy focuses on finding companies that have future free cash flow. So it looks at the previous cash flow and the future free cash flow to find those, sustainable companies that are focusing on generating that cash flow.
So, what is the portfolio construction process for the index?
Sure. So, what the index seeks to do is find high generative cash flow companies by starting with the top largest companies in the United States. So, it looks at the top 1,000 companies listed on the US exchanges. And then from there, it screens down companies that have high previous cash flow, high future cash flow, as well as those that pay a dividend. And in the dividend component, what it looks at is companies that have paid dividends and also increases them over time. So it has a dividend growth component where if you're a company that has paid a dividend over time and you've grown it over time, you get a higher weighting in the index.
When you look back on the first quarter, what changes took place in the index?
One of the interesting aspects that happened last quarter is we had a constituent come back in after they had a big share rise, and then they reported earnings again. And that was a leading semiconductor company that was in the index previously, but it had run up so much that we needed future free cash flow to kind of catch up for them to come back into the index. And so they did. They issued great earnings and had great guidance relative to what they had previously that precluded them from being in. So now the cash flow is caught back up and they've come back in, and they're a leading generative AI chip component supplier. So what's nice about them is they're a great example of companies that we try to find that have great previous and future that reinvest in themselves, pay dividends, do M&A. And one of the reasons why they're a leading generative AI company is because they've actually gone out in 2021 and purchased a company, and they're using that company as well as their own R&D to invest in that AI, and it's leading to future contracts.
So, Kevin, at a high level, where does this strategy fit into an overall diversified portfolio?
Well, portfolios are changing all the time given the high interest rate environment we're in right now, but this strategy and index is meant to be a core component in portfolios. And what I mean by that is that it's something that you want to own over time, and the index will constantly rebalance itself. So investors don't need to do that themselves. It's always going to adhere to those rules. So what you will see is index composition change over time, especially as the market evolves. And with that being said, it's a core component that you can slot in your US large cap equity component. So it should be a larger position because it is large cap US companies, domestic companies, which tend to be a larger portion of investors' portfolios.
All right, let's pivot and talk about HCOW, the Amplify Cash Flow High Income ETF. What is the investment philosophy of the index that ETF tracks?
So the HCOW ETF seeks to generate high income off of owning the underlying cows components, but then also having a structured covered call strategy. And by structured, what I mean is it's got a methodology to it. It's not let's sell this, do that, and subject to discretionary call selling. What it does is it's systematic call selling that goes out 2 weeks and less and sells calls against the overall market. So what it's doing is selling the market calls, thereby trying to reduce market risk by generating option income, and then also owning high quality US equities.
So, how would these two strategies complement each other?
Well, what's nice about cows is that it fits in just your large cap US equity position. What's nice about HCOW is it really gives a differentiated risk return profile versus just straight up equities because it has an option component to it, which helps diversify the portfolio in sort of an alternatives bucket or bond alternative bucket. And so, what I mean by that is we're looking at the fixed income space, and this strategy, option calling strategy, generates options premiums. So it elevates the income that's coming into this strategy. So you're getting dividend income and option income. So you can slide it into the fixed income alternative or just the alternative bucket of portfolios. So the nice aspect is you're trying to get high quality stocks and then also sell options against it. That fits in a nice little yield alternative bucket.
Excellent. Kevin, thank you so much for your time. Viewers, to learn more, visit amplifyetfs.com. That is amplifyetfs.com.